All right, good afternoon, everybody. My name is Thomas, and we're here with Heather, and she and I are going to be walking you guys through today's webinar about how to access your home's equity. Just a little housekeeping items up front. So if you'll notice on your screen, you've got a little yellow arrow that you can click to the left, and it will bring up a control box, and you can type in any questions that you may have right then and there. If you have any questions throughout the process, go ahead and shoot it over to us. We'll stop and answer them, answer those to the best of our ability. Again, my name is Thomas. I've been with the credit union for about not quite a year, and I've been in the mortgage business for about 20 years, not quite 20 years, 19 and a half or so. And we've also got Heather with us.
Hi, so I've been with the credit union 5 years, industry close to 30, only because I'm older than Thomas. So, so between the two of us, we've got about 50 years experience, and we're gonna help you realize the equity you have in your home and possible ways to use it.
Perfect. So first, wanted to just give you a quick market update of where things are at right now in the Utah market. Most of us are along the Wasatch Front. Some of us are in other areas, but for the most part, we're along the Wasatch Front, Utah, Davis, and Salt Lake counties. Right now, your home is worth more than it has ever been worth if you own a home currently. And rates right now are about 1.25% to 1.5% better than they were in the 2017 high that we've seen in the most recent 5 years or so. So as far as, if it's a good time to tap into your home's equity, there's never really been a better time to do that than right now with interest rates and values where there are. Certainly worth looking at if you're interested in that. So with that, let's chat about equity. Equity is defined as the difference between how much you owe and the value of your home. Other people like to call it how much ownership you have in the house. For example, we've got just a rough example up here. If you have a valued property of $500,000 and you owe about $200,000, you have about $300,000 in equity. Heather and I were talking before this began. You actually can't tap into 100% of that equity. There are limits on it, depending on what type of loan product you're going to be looking at. So, 80% is kind of the top value that you could tap into on any home, whether it's an FHA loan or a conventional loan. In this example, the max value that you could tap into would be $400,000 in a first lien position. We'll talk about that a little bit later.
And we're going to point out, just so it's kind of clear, so 400,000, but then you take away the 200,000 that you owe. So even though you may have 300,000 equity, you could access around 200,000 of it potentially. There are several ways to access the equity in your home. We can do a cash out refinance on your first mortgage, and that would be a cash out refinance up to 80%. We could do a fixed rate closed-end second mortgage up to 100%, but with the 100% caveat, there are caps on the loan amounts. Home equity line of credit, or HELOC, is the same as a closed-end fixed second. Now, then there's also reverse mortgages for the later years in life. That's something that you can explore. So when you're looking at cashing, well, let's talk about second mortgages and home equity loans. And with that said, please ask us questions. We will stop and answer them as we go, as much as possible, unless it's something that we're going to be coming up to. But please ask questions. We look forward, or we welcome them, and we want to get those answered for you. So a second mortgage that would be a closed-end, fully amortizing payment, that is something that you're going to want to use if you know that, say, you want to take 50,000 out right now. You want to consolidate a bunch of credit cards, or you want to remodel a kitchen. You've got a, well, we'll go into other things that you can pay for on the other side, the next screen. But closed-end second mortgage is more if you know you're going to take a lump sum out. A home equity line of credit is a really good option if it's something that you know you want to use and pay back. Use it temporarily, you're going to pay it back, and then you've got another expense coming up down the road, or just to have in place in case your furnace or AC goes out.
Which is important to understand, because I don't know if any of you have replaced any HVAC equipment in your home. I did that last spring, and it was about $11,000, and that hurt. So,
I did it last month, but my AC was 35 years old.
Wow, mine was 10. You definitely win. So would you go back to the last screen for just a quick second? So on that last screen there, we've got a second mortgage. So Heather mentioned a closed-ended second mortgage. What that is that you're taking a one lump sum, you get the entire loan amount up front, and then you make equal payments over the life of the loan until it's paid off in full. An open-ended second or a home equity line of credit is basically a revolving line amount. So, rough numbers, let's say you take out 50,000 and you only need 10,000. Well, if you draw the 10,000, you're only making a payment based on that 10,000, and you still have the remaining 40,000 available to you if you need it. It's also important to note that on our second mortgages, on all of them, there are no closing costs associated with it. Not something that we roll into the loan. There are zero out-of-pocket expenses, and there are zero expenses to you as the borrower, just because we love our membership and we want to take care of you. So if you're looking to tap into equity, there's ways to do it with nothing, with no cost at all.
With that said, we could even do cash out refinances with no closing costs. We've got different ways to work that so that we can use interest rate if it makes sense. You can roll them into the loan, but there are ways to do that without closing costs as well.
Yep, perfect. So some of the ways that you can use or that you might want to take out a line of credit or a second mortgage. Sometimes it's just for simply simplifying your finances. We've got life events that happen. You might have a wedding or a child that goes to college. Student loans are crazy expensive right now. You might have a growing family. You might have the need to upgrade a home or upgrade an existing home or even upgrade to a new home. There's lots of reasons why you'd want to do that. Home maintenance, we just talked about HVAC equipment. That stuff is very expensive. You might want to remodel a basement or remodel a home, bigger ceilings, nicer lighting, whatever. There's lots of reasons why you'd want to do that. Another great use of your equity is accessing the equity and using it to build wealth by purchasing an investment home or even a second home or a vacation home. Some people enjoy them for the use of emergency preparedness. If you've ever experienced a job loss or anything like that, that can come completely unexpected and you may not be prepared for it. Most financial planners will tell you should have around 6 months reserves of whatever your monthly payments are and your cost of living. You should have about 6 months set aside to be able to withstand any sort of job loss or family emergency that may come up. And again, a HELOC, home equity line of credit, is what that stands for. Some of the reasons you might need that, emergencies, we've gone over that. Business cash flow, sometimes you need additional cash flow for a private or small business that you need to access your home's equity to accommodate. So you're essentially lending yourself some money there to keep your business going, or for capital expenditures or growing or inventory or whatnot, whatever you need for the business. That's a great use of it. Future needs, short-term needs. There's lots of reasons why you can do that. Essentially, anything that you need money for, you can tap your equity for. So second mortgages have fixed rates. Term loans, we can do shorter term loans with really fantastic interest rates. We've got a 5-year right now at 1.99%, which is pretty amazing. So anyway, there's some reasons for you.
So I'm going to share my own personal story. We haven't had questions yet, so please, if you have questions, we definitely welcome those. So for the last couple of years, well, actually, I'll back up. So I bought my house 12 years ago, and my plan was to move out of my home after 5 years when my daughter graduated from high school. Well, she did graduate, and she moved out and bought her own home, but I haven't been able to find anything to kind of replace my home with. So what I've experienced over the last several years is that I have to spend more to get something smaller than what I have in an area that I don't want to be. So the last year, I've actually been looking very diligently at trying to find a home that maybe was everything, like that was completed. My home was built in 72, so it needs some things done to it. So I've been trying to find a home that was completely done, that was maybe a little more than what I could sell mine for. After spending a whole bunch of time looking around, looking at houses, looking online, even put in an offer on a couple, but they didn't feel right, even the ones I put an offer on. I came to the realization that I could put about 50 to 70,000 into my house, and it would be equivalent to me buying something that was about 200,000 more than what I would sell my house for. So I put a home equity loan in place. And as I've been telling everybody, I've been adulting hard. I've replaced my AC and furnace, had all my house painted because the paint was peeling, had my gutters replaced, and I had a 50-year-old electrical panel completely replaced. I started with those things because those were things that if I do sell my house, that would actually help and benefit. Now, maybe I'll move on to a few more things. I'm kind of done for this year though. But that was kind of a thought process I had. Instead of, I couldn't find the right house to buy, to replace it with that made sense. It made a lot more financial sense to actually break down and invest a little bit in my home.
Yeah, based on your figures there, you saved $140,000.
Yeah, yep. And so far, so far I'm less than, I'm only about, I did all of that for 15,000, everything that I did.
Wow. That's amazing. So there's a really good use for it, right?
Mm-hmm.
There's always a reason you can upgrade your home. And to your point, Heather, you're not just borrowing money and spending it, you're investing it back into an appreciating asset.
Yes.
And your home is probably, you probably get more bang for your buck by doing what you've done than just spending $15,000, right?
Definitely, yes. Yeah.
So that's not a bad way to go at all. So thanks for sharing that. We've got an example up here of debt consolidation. This would be like a cash out refinance. Say the example up here, we've got a family that bought a home in February of 2016 for $238,000. Good luck finding something like that in our market, but it can happen. Their original loan amount was $230,000, so they put $8,000 down, and they currently have an FHA loan with a balance of $220,000, so they put a little bit more, and they've made payments for 3 years or so. Over the past 30 months, they have remodeled and used some of their credit cards. Their current debt is, as you can see there, they've got, they've got 19,000 or so in credit card debt that they've used to do the remodel. If you look at the interest rates on there, their mortgage is by far the lowest interest rate, and that's generally where a debt consolidation loan will come into play. If you look at the interest rates on their Chase card of 4,000, it's at 14.75%. They have an American Express that's at 18.99%. They've got a Disney Visa for 21.49% and a Home Depot account for 23.99%. 23.99% is more expensive than most hard money loans. That's going to your local loan shark, and if you don't pay, they're going to break your knees or something like that. But think about that for a minute. So total payments are $1,850. With their mortgage that they've got, or excuse me, their mortgage insurance premium is $162.99. Taxes and homeowners insurance is $200. So all in, they're $1,850. The member, we call our clients members here because we're members of the credit union. They're asking for an additional $15,000 to finish the remodel on the main floor and the bathrooms. The total cost of their current financial model is as follows. Their mortgage insurance is $162.99 per month times 330 months. That's 30 years. Or no, sorry, that's the remainder of their 30-year term, but they've already done 3 years or so. They're 30 months into it. So if they keep paying that for the life of the loan, they're going to pay $53,750 just in mortgage insurance, which they do not get any tax breaks for or anything of the sort. Credit card debt in 10 years would be $42,000 in interest, assuming they don't make any.
That's crazy.
Yeah. On how much did we say? 19,000? 19,000 in debt,
man.
and they're going to pay $42,000 in interest. And that's assuming they don't increase it. They don't use it again, and they're just making the minimum payment until it's paid off in full. $42,000. The mortgage total cost is $358,000 over the next 330 months. So the total, if they don't do anything, is $454,000 before borrowing at 15 grand that they need to finish the remodel. So if we go on to the next screen, here's a possible solution. So they came up with 2 options for them. They can do a 20-year note.
Now this was put together, well, no, we'll leave that. So rates are different when you're getting cash out. That'd be that rate for 20-year be a little high for what they are now. It'd be more of a 2018 number, but still a very good example. Oh, sorry, I'll let you finish.
No, you're fine. So what Heather's saying is rates are better than this now. So assuming the rate of 4.875% with a new loan amount of 260, their new payment is 1897. There's no mortgage insurance on that. So right there, they saved that $53,700 or whatever it was. The total cost of the new loan is now $407,000. So they saved $47,000 right there. And they knock off 7.5 years of their mortgage that they had on the other option. They're increasing their payments by $47 per month, and they also have their cash in hand for the remodel. You couldn't borrow $15,000 on a credit card and have a payment of $47 a month. So the refinance makes absolute sense in that scenario. The other option would have been a 30-year loan. Somebody who's starting out, generally speaking, and this is just my opinion, but generally speaking, if you have the ability to do a shorter term loan, I generally don't recommend you do it because you're locking yourself into a significantly higher payment. Just in these two options here, you look at the difference in payment, $1,897 versus $1,595. So, and it accomplishes the same thing. The only difference is it doesn't save them the 7.5 years. So, that's a conversation we can have at a later time. But anyway, this other option was a 30-year note, same dollar amount, $260,000. Their new payment $1,595, no mortgage insurance. It actually saves them $255 per month, and their cash in hand for the remodel is $15,000, and they can proceed with what they're trying to do. So this is just one of, several options that we've got, and our options are fairly unlimited depending on what your goals and needs are. We can accommodate a loan product specific to your needs, and that's what I do. That's what Heather does. That's what our jobs are, is to make sure that we can figure out what you're trying to accomplish and then put you in the best product that'll accommodate that.
So I'll share a scenario I put together this morning. It's kind of last opportunity to put some questions out there if you have it. But so I had a member call this morning, and they're pretty low loan value on their house, and they had about $25,000 in credit card debt that they wanted to get paid off. And so I asked them what their desired payment would be and what they were currently paying. In my head, I already knew I could go down to a 15-year, pay off all their credit cards and keep the payment below what they were willing to pay. And then after I ran the numbers, it did come out to that. So I took them, they have about 25 years left on their first. Credit cards, do they ever get paid off if you're just making the minimum payments? But so I took both of those, worked it into a 15-year, told them the payment, and they're like, that's great payment. They were super excited about it. It was like $175 less than what they were willing to pay. And then I said, now the bonus part is it's a 15-year. So done. They're like, yes, let's do that. Saves them tons and tons in interest and cut 10 years off of their mortgage. So something to think about if you have quite a bit of equity in your home. You can simplify your finances, put everything together, and shorten the term significantly, and pay less than what you're paying right now, probably.
To give you an idea of just how much equity you may have in your home, so in Salt Lake County, Utah County, and Davis counties respectively, they have all seen double-digit appreciation for over the last 3 years consecutively. So what that means is you have at least 30% more equity in your home if you've owned it for about 3 years. You've about 30% more value there than what you did when you purchased it, which is pretty incredible. In a healthy market, a really strong market, anywhere from 3 to 6% is a really good real estate market. And we've been seeing double digits. 2018 in Salt Lake County saw 13.5% appreciation average rate. So just keep that in mind. You may have significantly more equity in your home than what you realize. So if you've ever thought about it and you want to explore those options, give us a call. That's what we're here for. All right, last call. Any questions? I don't see any questions popping up. We'll give it another second, but here's our website right there. There's all of our mortgage consultants. You can see my bald head down there on the bottom, Heather's next to me on the left. We've got Marky Johnson, we've got Alan, we've got Taylor, we've got Dawn, Heather, and myself, and Sean, and we're all available on that same phone number right there, 801-481-8840. That is a hotline that you can reach any of us at. Whoever's available will take that call and answer whatever questions you may have. So if you have any questions at all, feel free to reach out.
All right, so we do have one question. When is an appraisal required? Typically, anytime that you are getting cash out, it will always be required. There are, if we're just looking at a straight refi, there are times when it, I'm gonna use meets the proper algorithms and gets waived. I've just been looking for a time to use that word. No, but once in a while they get waived, but typically they're never waived if we're getting cashed out. Now, as far as appraisals, that's something that typically we can find a way to get that covered if cost is something that you're being concerned about. We also have another question. Or do you have any things on appraisal? Sorry.
If it's a second mortgage, a home equity line of credit or a second mortgage, the credit union actually pays for those appraisals for you. So there's no cost associated with those at all. And then I was going to mention too, everybody that is on this webinar with us is going to receive an email from the credit union with a coupon it for a $500 lender credit on any future transaction. So use that however you'd like. So.
Then Thomas brought up the second mortgages. I wasn't really thinking along that same lines. So with our second mortgage, sometimes we will do a desk review appraisal. If there's significant equity and the tax assessed value is sufficient, then we'll just use the tax notice for the second mortgages and home equity loans. All right, the next question is, if your current loan is with if your current loan is with another financial institution, can we still utilize these services with the credit union? Definitely. So we can do second mortgages behind another lender, but we'll also want to make sure that we're putting you in the best financial situation possible and take a look at that other mortgage and see if it makes sense to refi. And if it's straight up in a great position, and the cash that you're getting out at a potentially higher rate, if that's still the best scenario, then we'll do that. Sometimes if you have, say, 100,000 on a first at a low rate and you're getting 100,000 out on a second at a higher rate, it might make sense to blend them and do a rate that's in between.
Yeah, I'd agree with that 100%. I'll give you a quick scenario. So I'm working with a member right now who came to me about a week ago, and he was just curious. He said, we had bought our home about 6 or 7 months ago using an FHA loan, and it has a pretty steep interest rate at the time. Just so you know, interest rates are mostly driven by loan to value and credit scores. And then there's some differentials in there based on loan to value, stuff like that. But for the most part, they're credit driven. So when you ask for, what are rates today, that's going to be a specific rate for your specific scenario. There's not just a blanket rate that every deal we get that day is that rate. So just be aware of that. But anyway, this guy called me and he said, I'm looking at possibly refinancing. I've seen what rates are advertised right now, and I just want to double check. He thought that his interest rate was 4.25%. And I asked him to give me just a copy of his current mortgage statement. He was able to pull it up on his phone and shoot it to me right then and there. He was actually at 5.5%.
Wow.
On an FHA loan, which is really high.
That's really high.
And so we took his loan application, I priced everything out, and we are refinancing him to 3.75%, also getting rid of mortgage insurance. And it's a fairly significant loan size. He's saving about $400 a month by doing this. And we're rolling the closing costs in. He breaks even on that in like 9 months.
Wow.
And he's like, you're serious? I can save that much? And I said, yes, and we locked it in and we're moving forward with it. So a lot of times it just takes a set of eyes of knowing what they're looking for and then being able to advise you on something that, our goal is to make sure that your finances are the best they could possibly be. As our membership, we want to make sure that you're in good hands, and that's our goal. So great questions. And if there are no other questions, if you find you have some later on, feel free to give us a call back at 801-481-8800.
Thank you so much for joining us today. We appreciate your time.
Absolutely. Thanks, guys. Have a good day.